The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding bonds. This is the first video in a series of 2 on understanding bonds. In this video, we will look at basic bond features and the types of bonds. Basic bond features. Before we look at bonds, let's consider a common borrowing arrangement such as a home loan. When you take a home loan, the bank is the lender and you are the borrower. The bank's obligation is to lend you an agreed sum of money. Your obligation in the meantime is to make payments of the principal and interest at regular intervals, which would have been specified in the loan agreement. Now, what if a very large sum of money is needed, more than what a single bank or lender is prepared to provide? For example, when a company or a government wishes to borrow a big sum, it could be difficult to negotiate individual loan agreements with numerous lenders. Here is where bonds come into the picture. Bonds are issued by only 2 entities, governments and companies. They are debt instruments where the entity issuing the bond is the borrower and the investors in the bond or bondholders are the lenders. In other words, if you invest in a bond, then you are the lender and the government or corporation is the borrower. This is the reverse of the home loan arrangement where you are the borrower. Just as in a home loan, in a bond, the borrower agrees to make payments of interest and principal to lenders at pre-specified dates. However, the difference between home loans and bonds is that, unlike the home loan, where the lender is the same throughout the period of the loan, bondholders can sell their bonds in the market. In other words, the investor holding the bond when it matures may be different from the original investor who bought the bond when it was issued. One common bond term is the word coupon. It comes from a past practice when paper bond certificates were issued with coupons literally attached to them. On each due date, the bondholder simply brought a coupon to the bank to exchange for the interest payment. Until today, the annual interest payable on the face value of a bond is referred to as its coupon. Let's look at some other common terms in bond investing and how a simple bond works. In this example, the bond is described as ABC 3% 280630. This bond was issued by ABC Company on 30th June 2018 and carries a coupon rate of 3%. It is a 10-year bond, so it matures on 30th June 2028. This is known as the maturity date and is shown as 280630 in the bond's description. The bond pays interest semi-annually, that is, every 6 months. At the maturity date, ABC Company will make the final interest payment as well as repay the face or par value of the bond. It is important to note that the face value is not the same as the market value. The face value is fixed, usually in multiples of $1 or $100, but the market price of the bond may rise or fall depending on a variety of circumstances which we will explore later. For now, suppose an investor buys $10,000 worth of these bonds at their face value at the date of issue on 30th June 2018. The coupon interest of 3% is based on the face value. which means the annual interest payable is $300. Since payments are semi-annual, this means that the investor will receive $150 every 6 months, starting on 31st December 2018, followed by 30th June 2019, and so on. On the maturity date of 30th June 2028, ABC will pay the final $150 and the face value of $10,000 to whoever is holding these bonds at the time. The secondary market for bonds. Earlier, we said that bonds differ from home loans because bonds can be bought or sold in the secondary market. We also mentioned that the market value of a bond may differ from its face or par value depending on a variety of circumstances. This means that the yield or rate of return on a bond will depend on how much the investor paid for it. Yield to maturity is the yield that is most commonly used by investors. It is the internal rate of return for the bond, taking into account all cash flows from purchase to maturity. It is assumed that the coupons received are reinvested at the bond's prevailing yield. In this example, the yield to maturity of the 10-year benchmark bond NY091000H, which has a coupon rate of 2.625%, is 2.51%. It is lower than the coupon rate because its price has risen from $100 to $100.97. It is important to note that a rise in the price has lowered the yield. In other words, price and yield move in opposite directions. Another thing to note when looking at bond prices is whether it is quoted with or without accrued interest. Unlike shares which pay dividends only at the discretion of the company's management and board of directors, bond issuers are obliged to pay the contracted coupons on fixed coupon dates. This means that even if bond prices are quoted without accrued interest, the interest will be accrued and paid to the seller up to the date when the bond is sold. We will explore the concept of accrued interest next. Accrued interest is the coupon interest that has accrued from the last coupon payment date to the settlement date for the bond purchase. Although bonds can be quoted on a dirty basis, which means the price includes the accrued interest, for simplicity, bond prices are usually quoted on a clean basis, which means the price excludes the accrued interest. However, once a bond is sold, the traders would have to calculate how much the accrued interest is and add that to the settlement price that the buyer has to pay to the seller. What we have here is a typical bond, and here are its features. The issuer for this bond is Temasek Financial IV Private Limited, and the coupon is 2.7%. The maturity date is 16th October 2023, 5 years from issue on 16th October 2018. If the price is now $1.017, the bond is trading at a premium to the face value of $1. Previously, we noted that prices and yields move in opposite directions. So in this case, since the price has risen, the yield will be lower than 2.7%. A typical bond. These are the main types of bonds: government bonds and Singapore savings bonds, corporate bonds, perpetual securities, and bond funds and exchange-traded funds. Government bonds. Besides collecting taxes for revenue, governments can also issue bonds to obtain long-term financing. In most countries, the government is considered the safest issuer to whom you can lend. Government bond yields are therefore viewed as the risk-free benchmark rates for that country. On the other hand, when companies issue bonds, they will have to pay more than the benchmark rate in order to compensate investors for taking on various forms of risk. We will explore these risks later, but for now, it is important to always ask the question that should be asked for any form of borrowing. What is the borrower's ability to pay? Although government borrowings are generally considered the safest, there have been government defaults in the past. For example, Greece in 2012 and 2015, Argentina in 2020, and Sri Lanka in 2022 were all unable to meet their bond payments. Singapore Government Securities, SGS. In Singapore, government bonds presently issued for individuals to invest in are known also as Singapore Government Securities or SGS. These fall into three categories: Treasury bills or T-bills, SGS bonds, and Singapore Savings Bonds or SSBs. T-bills are short-term bills that mature in 1 year or less from their issue date. They are issued at a discount to their face value. When the T-bills mature, the government pays the holder an amount of money equivalent to its face value. You can buy T-bills at primary auctions via local bank ATMs or their internet banking portals. The minimum investment amount is $1,000. Thereafter, in multiples of $1,000. For SGS bonds, there are presently three types. SGS Market Development Bonds are available for tenors from 2 to 50 years, are backed by the Singapore government, and are not used to finance government budgetary spending. You can buy these bonds at primary auctions via local bank ATMs. The minimum investment amount is $1,000. Thereafter, in multiples of $1,000. The aim of issuing these bonds is to build a liquid SGS market to provide a robust government yield curve, which serves as a benchmark for the corporate debt market. These bonds are also issued so as to grow an active secondary market and to encourage issuers and investors, both domestic and international, to participate in the Singapore bond market. The second and third types of SGS bonds are SGS Infrastructure and Green SGS Infrastructure. These are issued under the Significant Infrastructure Government Loan Act 2021, or SINGA, which authorizes the government to borrow up to $90 billion to finance major long-term infrastructure. You may bid for Singapore Government Securities, SGS bonds, and Treasury bills, T-bills, at primary auctions. Check the MAS website for scheduled auctions, announcements, and results. Singapore Savings Bonds, or SSBs, were introduced in 2015 to provide an additional option for retail investors to build up their savings and become a bit more comfortable with investing in a capital market instrument like a bond. There is a new SSB issue every month. They are safe, since they are issued by the Singapore government; for the long term, since interest payments increase over 10 years. This means the longer they are held, the higher the return. Flexible, since they can be redeemed anytime before the maturity date. If you do redeem your SSBs, you will be paid your invested amount plus the accrued interest. There is also no penalty for early redemption. Other features of investing in SSBs are: the interest is tax-exempt. The minimum amount needed is $500, whilst the maximum across all issues is $200,000. They are only available to individuals aged 18 years and above and who have a central depository account. They cannot be traded in a secondary market. Here are the steps needed to apply for SSBs. Step 1. Open accounts. Applicants must have either of the bank accounts below: DBS or POSB, OCBC, UOB. Applicants must be at least 18 years old and undischarged bankrupts with individual CDP securities accounts with Direct Crediting Service, DCS, or a supplementary retirement scheme account with DBS or POSB, OCBC, UOB. Step 2. Apply through DBS or POSB, OCBC, UOB internet banking or ATMs or OCBC mobile app. But do note that applicants cannot apply over the bank's counter. Funds are deducted at the point of application. A $2 transaction fee for each application request is payable. Corporate bonds. As mentioned earlier, corporate bonds come with higher risk compared to government bonds, so they have to pay higher coupon rates. There are generally two types of corporate bonds: wholesale bonds and retail bonds. Wholesale bonds are sold to institutional and accredited investors, as the minimum is typically $200,000 per transaction. Retail bonds are sold to retail investors, and the minimum can be as low as $1,000 per transaction. Retail bonds are listed on the SGX, and you can buy and sell them just like shares. Under the seasoning framework, certain wholesale bonds can be redenominated into smaller lot sizes and offered to retail investors after a 6-month seasoning period. Instead of a full prospectus, the issuer will provide a simpler product highlights sheet. Under the exempt bond issuer framework, issuers who satisfy the eligibility criteria at higher thresholds can offer bonds directly to retail investors without having to wait for the 6 months seasoning period. Corporate bonds come with various features. They can be callable or puttable, or they can be zero coupon or convertible. Callable and puttable bonds. The issuer of callable bonds has the right, but not the obligation, to redeem or buy back the bonds before their stated maturity date. Call dates may be predetermined, and the issuer must pay a call price to the investors of the bonds upon early redemption. Issuers are likely to exercise their call option when interest rates are low or falling, since they may be able to refinance their loans at a lower market interest rate. Since the advantage lies with the issuer, the coupon is usually higher than its plain vanilla bond counterpart. On the other hand, puttable bonds, or those with a put option, give bondholders the right but not the obligation to have the bonds redeemed before their stated maturity date. That is, bondholders can put or sell their bonds back to the issuer if they wish. Bondholders are likely to exercise their put option when interest rates rise. Since the advantage lies with bondholders, these bonds usually have a lower coupon versus their plain vanilla bond counterpart. Convertible bonds. Convertible bonds are usually issued by smaller, high-growth companies who may find it difficult to secure financing at attractive rates. So the bond that's issued will have a lower coupon rate than a comparable plain vanilla bond. However, it can be converted to shares at a predetermined ratio. The idea here is that if the company does well, then its share price will rise and the bondholder will then benefit from conversion. This will then make up for the lower coupon rate. In this example, the conversion ratio is 40:1. This means the face value can be converted to 40 shares. Using a face value of $1,000, this means that if converted, the bondholder is essentially paying $25 per share. If the current share price is $24, it does not make sense to convert. However, if the price rises above $25, then conversion becomes attractive. The conversion can be expressed as a ratio, for example, 45:1. It means that the face value can be exchanged for 45 shares. It can also be expressed as a conversion price. For example, $25 in the example above. If the market price is above $25, then it's worthwhile to convert and then maybe sell the shares. Zero coupon bonds. Zero coupon bonds do not make coupon payments, but are instead issued at a discount to the face value. They are usually long-term with maturities of at least 10 years. At redemption, the bondholder receives the face value. These bonds allow investors to plan for long-term goals, such as saving for a child's college education. The idea is that with a discount, investors can place a small amount of money into the bond, which will then grow over time. However, because they do not pay any coupon interest, they are more volatile than normal bonds. Perpetual securities are hybrid securities that combine the features of both debt and equity. As the name implies, they are perpetual, which means they do not have a maturity date. This means the issuer is not obliged to redeem the securities at all and also may defer paying the coupon perpetually. Holders will therefore be exposed to market price fluctuations and liquidity risks perpetually. In the event of a winding up of the issuer, holders of perpetual securities normally rank ahead of ordinary shareholders but behind other creditors for repayment. Bond funds. Just like equities, you can also invest in bonds via pooled investment funds such as unit trusts or exchange-traded funds or ETFs. Both are diversified portfolios of bonds managed by professional fund managers. They provide diversification with a small capital outlay. Unit trusts are unlisted and are typically sold over-the-counter, OTC, via brokers and authorized financial advisors. They are actively managed. Bond funds can be global, regional and country-specific. They can also be investment-grade and high-yield. Because unit trusts are actively managed, transaction costs will include upfront sales charges, back-end redemption fees and recurring fees. There is also an expense ratio, which will include all the management fees, trustee fees and custodian fees that are charged to the fund directly. Unlike unit trusts, ETFs are listed and are usually passively managed. Bond ETFs track the performance of bond indices. Cash bond ETFs will invest in the underlying bonds directly, whereas synthetic bond ETFs will use derivatives such as futures and options. Synthetic ETFs are more risky given their complex structure and are therefore most suitable for institutional and professional or accredited investors. Here are the key takeaways for this video. A bond's yield to maturity is its internal rate of return until maturity. It moves in the opposite direction to its price. Callable bonds give issuers the right to buy back their bonds, usually when interest rates fall. Puttable bonds give bondholders the right to sell their bonds to the issuer, usually when interest rates rise. The government-issued Singapore Savings Bond, or SSB, pays interest that steps up over 10 years. SSBs can be redeemed anytime with no penalty.